Renewing a $500,000 mortgage at 5.5% instead of waiting for a projected 4.5% in late 2026 could cost you about $28,000 more in interest over 5 years, based on Bank of Canada rate path estimates. That's not a typo, and it's the exact number your lender's Lock In Today letter quietly ignores. I read the fine print so you don't have to, so let me show you why the timing of one signature matters this much. The simple version is this. When your mortgage term ends, you sign a brand new loan at whatever rate exists that day. But here's the complication most people miss. Your bank lets you sign that new loan up to 120 days, about 4 months before your term actually ends, which means you can accidentally lock in an older, higher rate. Fixed mortgage rates aren't set by the Bank of Canada directly. Lenders price them off. Government of Canada bond yields and rate expectations, so the policy rate flows through with a lag. Think of it like a weather forecast. The bond market prices in tomorrow's storm before the clouds actually arrive, which is why fixed rates can fall before any official cut lands. By late 2025, economists at major institutions were projecting policy rate cuts through 2026 as inflation moved back toward the 2% target. That implied fixed mortgage rates would keep drifting lower as the year went on. Think of it like waiting for a sale you can see coming. The markdown is scheduled, so buying the day before makes little sense. On a $500,000 mortgage with a 25-year amortization, 5.5% costs you roughly $82,000 in interest over the first 5 years, while 4.5% costs roughly $54,000 per the brief. That 1 percentage point is about $28,000 in your pocket or theirs. Think of it like paying $3,060 versus $2,480 a month for the exact same apartment. Same home, very different bill. Your lender's early renewal offer sounds like a favor, but the 120-day window lets you lock in a rate that still reflects earlier, higher policy rates. Think of it like buying next season's coat at full price 4 months before the end of season markdown. If this breakdown is useful, subscribe. The next one is already coming. Take Sarah, a Toronto marketing manager with a $500,000 mortgage maturing in October 2026. Her lender dangles a June renewal at 5.5%, but if she waits and captures a projected 4.5%, she saves about $280 a month and roughly $28,000 across the term. Think of it like signing in June versus October. 4 months of patience worth $28,000. Before I get to the last part, which is the most counterintuitive piece of this. Here's the twist. Renewing early at the higher rate doesn't just cost interest. It squeezes your monthly cash flow, which quietly sabotages your tax planning in the exact same year. Think of it like 2 small leaks in the same boat. Separately annoying, but together they can sink the whole plan. Here's the buried detail. The 2025 RRSP deadline is March 2, 2026. And a $10,000 contribution at a 30% marginal rate creates about a $3,000 refund per the brief. But when a higher mortgage payment tightens your budget, that's exactly the contribution people skip. Think of it like leaving a $3,000 gift card unclaimed because your wallet felt tight that month. The second catch is your TFSA. The 2026 limit is $7,000, and long-eligible savers have $109,000 in cumulative room, per the brief. Yet Sarah has used only $20,000 of it. Keeping $20,000 in a taxable account at 4% loses about 1.2 points a year to tax, roughly $2,400 over a decade. Think of it like a slow tax strip on every dollar sitting outside the shelter. Stack it all up for someone like Sarah, about $28,000 in extra mortgage interest, $6,600 in lost RRSP refund and growth, and $2,400 in TFSA tax drag, per the research brief. That's roughly $37,000, and with bigger balances, it realistically pushes past $40,000 over a decade, all traceable to one early signature. So here's what to do. First, log into your banking portal, find your maturity date, and don't renew early unless Bank of Canada guidance points to rising rates. Aim to renew within 30 to 60 days of maturity. Second, check your RRSP room in CRA My Account and hit the March deadline. Third, confirm your TFSA room and move taxable savings in. Think of it like reading the sale dates before you buy. Timing is the whole discount. The renewal letter is designed to make early feel safe, but now you know the timing is where the thousands hide. Next, I'm breaking down mortgage prepayment penalties. How the interest rate differential is really calculated and why breaking a term can cost far more than you'd expect. Subscribe so you don't miss it.